And we're live with the virtual real estate investing podcast. I'm doing awesome. Frank, I hope you're doing awesome too. How you doing today, man?
I am doing really good. Business is booming in Q2. So work's good, family's good. I'm feeling awesome.
Excellent. And what are we talking about today, man?
Well, it was your idea, but today we're going to talk about how to fund deals and the use of leverage and why it's important to your business or your real estate business.
Excellent. And tell us the background. Why did we get to this point? Let's talk about our course or our not course. That's not a real word, I know, but let's talk about our plan and how we ended up here.
Yeah. So about 2 months ago, we had our Q2 planning offsite with our team, and we said, hey, like we have really ambitious revenue goals. Like, how do we make money? And we're like, well, we're really good at finding, funding, and finishing deals anywhere in the country, right? That's the 3F model, I guess we created. And we're like, well, let's teach people how to do it. So John and I have filmed, I don't know, 25 to 35 hours of us teaching stuff, and it's on our Google Drive now. And funding deals was one of those modules or parts of our course. And we decided like 2 weeks ago, we're just going to give it away for free. So we're just going to start covering this stuff on our podcast. And I guess part of the reason was like there's a lot of people doing education right now in the real estate space. And we kind of want to just be abundant mindset people and just give it away. And we'll figure out how to monetize all that stuff later. But we're just giving it away. That's it.
I like it, right? Like if we charge for it, we could make money in the short term. But I think in the long term, right, like we're going to be able to connect with a lot less people. So let's give it all away for free, and we'll go from there. So Frank, that being said, what is leverage? What is debt? What are mortgages? Do I have to have all cash to buy properties? Talk to me, man.
Well, I'll answer the first part, right? I think in today's environment, you have to be willing to buy things all cash to get good and awesome deals in the single family space. It's so competitive. Even in cities like Austin, you need cash offers to buy deals on the MLS or the primary market. Like if you try to come in with a lender, sellers are telling you go kick rocks, right? It's just too hot, right? So we learned that pretty quickly. Going the agent route, going through the MLS, and trying to go using conventional financing to buy distressed properties is can feel at times like batting your head against the wall, right? So if you're not using creative strategies like subject to seller finance, you need cash, okay? So that's just one. You need it to be competitive, I think, in single family in today's market. But two, once you start getting those good deals, right? Maybe you have enough money in your checking account or your SDIRA or somewhere, and you could buy a property cash. Maybe you can do that. Once you succeed and you realize like, oh, I have a potential business opportunity here. Well, then what do? Do you have $10 million lying around where you can start hustling and buying properties with that? You probably don't, because if you have $10 million, you're probably not hustling in real estate. You're probably doing something else. You're probably on vacation and earning your income more passively, right? So you need other people's money, right? That really is it. Like leverage allows you to go further, to do more business, buy more deals if you're finding good ones, and keep less of your money in those deals. So you can use that money to do other stuff. That's the primary purpose of leverage.
So leverage, debt, a mortgage. Is it fair to say on this podcast, all those words are kind of interchangeable? It's a money that's not ours that we're going to use to purchase real estate?
I'd say so, right? I think you can achieve leverage in a lot of different ways. And yeah, raising debt is definitely one of them.
So why would a seller in Austin, Texas right now, super hot market, why would they prefer an all cash offer over a traditional, non all cash offer?
Well, there's no risk of the lender deciding that the buyer is not qualified, right? So if someone's showing you a proof of funds for $1 million to buy the house, you don't have to worry about the lender worrying about the credit score, right? So the approval process doesn't exist, right? The cash is cash. The other thing that it also eliminates is the risk of the appraisal not coming back high enough, right? If you're going through a conventional loan and you're a buyer, your lender will order an appraisal, and that appraiser will appraise the house. If the appraisal comes back below the sales price, then that buyer needs to bring those funds to the table, or the appraisal needs to be appealed and you need to request a revision. That's all that equates to is hassle and time, right? So what cash does is there's no hassle and it's way less time, right? A traditional lender needs about 45 days to close. Cash, I mean, if you're all comfortable and that seller's ready to move, you could close any day, assuming that the title is free and clear. So cash is all about speed and convenience.
And then you're saying cash, but we actually don't mean our own cash. We mean someone else's cash, right?
Yeah, that's right. So we have bought all of our properties cash, but with the money of hard and private money lenders. And it's probably important to distinguish between the two, right? A hard money lender is usually a lender that they are giving out bridge financing or these types of loans as a business. It is their core business. They are lending out debt on typically shorter durations, right? So instead of having a 30-year mortgage on your home, it's likely to be a year, maybe even 6 months, right? It depends, right? It depends on the deal. But that lender is saying, hey, I'm going to give you $500,000 to buy this house, likely so you can fix it up as well. You have to pay me back the entire balance in a year. That's known as a balloon payment. So it's a 1-year note. Give me all the money back in a year, and they're typically going to charge you higher interest rates. Hard money right now, the lowest I see from the big hard money lenders is like 8.5 to 8.25% interest on a 1-year note. But I've seen hard money lenders charge to newbies like 13 to 14% annual cost of capital, maybe even higher, right? So it really does depend. There's a really wide range there. But that's what they do. That's what hard money do. The hard money lenders do. The private money route is like your rich uncle or your friend of a friend that has millions of dollars lying around, or at least hundreds of thousands of dollars lying around. You can go to them and say, hey, I'm starting my real estate business, I'm trying to buy this house. It's $500,000 total cost of the project. How would you like to earn 8 or 9% on your money that's just lying around in your checking savings account, right? They lend you the money, usually similar terms though, 1-year note, 2-year note, maybe maximum. And that's the private route. You're borrowing from people that have access to capital, but maybe it's not their primary profession is to give it out to real estate investors.
Okay, so if we look at our own cash, right? Like we use money that is currently in our bank account, or if we use a traditional mortgage, or if we use hard money, or if we use private money. Like we've got those 4 options, right? Mm-hmm. So can you try to make sense of kind of the pluses and minuses of each of those options?
So the minuses for, I'll do hard money and private money first. The con of hard money is typically the terms and the closing costs are the least advantageous. Your cost of capital is the highest, right? The advantage of hard money though is it's hard to outgrow a hard money lender, right? Like if you're doing 5 to 10 off-market deals a month and you're paying cash for those at closing, most hard money lenders could support that, right? They have tens of millions of dollars of capital that's ready to be deployed. So that's a big pro of hard money lenders. You'd have to be pretty big to run out of money, right? As long as they wanted to keep lending to you. And conversely, for private money, that is one of the cons, right? Unless your uncle, like the person I referenced before, is really, really wealthy, you can eventually outgrow them, right? Like we don't have a private money lender right now that could bankroll our entire quarter's worth of purchases, right? So that's the con of private money. If you have that problem solved, like good for you, right? Then like, keep going. But the pro of private money is you could still get short-term financing, like 1-year loans at, I think, more advantageous rates. Typically, I think you can get the interest rates and the points a little bit lower. And then the other benefit is the closing and the origination fees, like the document prep and all those other things that you pay for at closing, you can pretty much eliminate those because you can just tell the title company, hey, work up a note, or you could do it yourself, right? And then all those transaction costs kind of go down. But conventional, since we're talking conventional financing too, the pro of conventional financing is it's less risky, right? You're probably gonna have to put more of your own money into a conventional home purchase loan. It's 20% to avoid PMI on a lot of conventional loans. If you're getting a VA loan, you can do 0 down potentially, but it's going to take longer, right? No matter what you do, a conventional loan is going to take longer. So those off-market deals might be difficult to get. A wholesaler is not going to sell to you, most likely on a conventional loan. It's not going to happen. So you're probably going to pay higher prices, but it's less risky from a loan perspective. You pay lower interest rates, and you're going to get a 15 or 30 year duration. So that's really it.
Excellent. And I've heard you say the term bridge, like a bridge loan. What exactly does that mean?
It's well, you can look at it as a bridge in the sense that it's allowing you to get to another place, right? You never want to hold on to a bridge loan or a hard money loan forever. It's not your final destination. It's a bridge to either sell the home. If you're flipping it, you're getting rid of the house. So once you sell the house, you can pay that loan off, right? It's a bridge to flipping it. It can also be a bridge to another loan. And what I'm referencing is the BRRRR strategy. You buy, you rehab a house, you put a tenant in and you rent it, and then you refinance. It is the bridge to the refinance in that particular equation. So how that would look like is you get your hard money loan. Maybe you're paying 9-10% interest on a 1 year note. You fix up the house, you stabilize that particular asset, meaning that it's rented, market rents, good to go. You get your next lender, your conventional financing bank or credit union, and you say, hey, I got this stabilized asset. Can you do a cash out refi on this particular house? That lender appraises that house. They say, hey, good to go. They help you pay off that bridge loan. And now you just have a 30-year or 15-year mortgage on the house and you're cash flowing. That's the BRRRR strategy.
Gotcha. And how would you respond to the Dave Ramsey people, right? Or the people that are like, hey, you're talking about debt. I don't do debt. I don't want to listen anymore. None of this matters. Like, is there a place for that in real estate investing, or do you have to use leverage? What are your thoughts?
If you want to do this professionally and at any level of scale, then I don't think you can take Dave Ramsey's advice. I think Dave Ramsey's advice is really, really good if you're just focused on your savings and checking account, right? And getting your finances together. But if you're looking to be aggressive, I think that's going to limit you to the point where you can't be competitive in today's market. Buying real estate without leverage, like think about buying 10 houses without raising debt or any type of capital. I mean, how much money would you need to do that? 99.99% of America is not going to do that. And the people that have that amount of money are not wholesaling and flipping houses. They're just not, right? So it's in this particular case, like if you're nervous about raising debt and you're thinking about getting into real estate investing, I think you have to accept you have to get over that, period.
Excellent. So let's say I find what I think is a great deal, right? Like I'm working with a wholesaler and they send me a deal in Omaha, Nebraska. I'm from Omaha, Nebraska. I love this deal. I put it in my spreadsheet. Like I feel really good about it. What should I do? Like, where do I go from there to buy this thing, man?
I think you start out with the hard money lenders because you know that they're out there trying to lend. They have people that are salespeople that are looking to place the money, right? So it's not hard to find them. They market. They have advertisements. They have salespeople, like I said, so you can find them, right? And the number one quality that I'm looking for in terms of money is availability. It's like playing sports, right? Like what's the number one skill in the NFL? It's availability. Like you're not injured, like you're ready to play, right? Those hard money lenders are ready to play. And the last thing you want is to have this opportunity to have a great deal and maybe you're going to make $30,000, $40,000, $50,000 profit and you can't close, right? I'd rather pay extra points or interest rate to make sure I make that money, right? If you're just telling me I have 30 days and go, like I'm making sure I can get the money, right? So I would start with the hard money lenders if it's your first deal. But in parallel, once I felt somewhat confident that I had a pipeline or a stable of people that are interested in lending to me, I'm starting to hustle private money on the side because as a newbie, you're going to pay the highest interest rates and points on your first couple flips or your first couple BRRRR transactions. You're not going to get the best terms. So I actually think private money could be the most advantageous at the beginning, right? Because it's probably the biggest difference in cost of capital. So I would start, honestly, the way I did it, I did Bill Allen's Flip Hacking Live 30-day challenge. I went on social media 30 days in a row, and I just told people I was going to buy like $500,000 or $1 million in housing in the next couple months. And I probably raised 300, 400 grand just from that activity. People saying, hey, I love what you're doing. I got a buddy that owns 20 gyms out in Los Angeles. I'm going to connect you guys. Get on the phone, right? Like, okay. Told them the business plan, the house or the type of house I'm trying to buy. I don't even think I had a deal ready. I think I just said, this is what our typical deal looks like. and I made a PowerPoint deck out of it. And the guy was like, "Hey, I love it," and he had, I don't know, 300 grand lying around in a savings account earning 0.0001% interest, whatever they make nowadays. And, the 9% I was offering that person is a lot more than that. So committed 300 grand right there.
Excellent. Let's dig into hard money first. If you're a newbie, how do you find a hard money lender? You just type in hard money lender in Google. What's your recommendation?
Well, you could. I mean, you could. You could also go to Bigger Pockets or other large forums and look at what other people are saying, and you could find one. But I really do think it's one of those things where referrals kind of rule supreme. So if you're in Facebook groups in your local market, I definitely think you should check those out and ask around of who's really good for a couple of reasons. I tend to find in the hard money space that the people with the lowest rates tend to cut corners on operational expenses and tend to have the worst customer service, especially on the big players. I'm not going to name any names, but I've been through a couple of these processes, and sometimes you pay for the low rates in other ways, right? And then some of the smaller shops will have some of the higher rates, I find, right? So I'm looking for like that middle ground hard money lender that maybe is not trying to get like at 8% or below, but I know that they're offering a really solid rate, and another investor has told me that they work with them and that they're convenient. That is the most important thing, right? Like if you're holding a house for 3 months, 4 months, which is the average flip, that 0.25 or 0.5 in interest you're paying is irrelevant compared to the risk of not closing the freaking deal, right? So I try to avoid hard money lenders that have a lot of processes, a lot of red tape, and take forever during the underwriting process. Once I start seeing that, I'm like, I'm never using these people again, right? Because if it looks chaotic, it's chaotic. So that's to me the sign that I'm going to move on.
And then how do I know a hard money lender isn't a scam? And I say that we've got a Facebook group called Virtual Real Estate Investing. And almost on a daily basis, someone will post in there some ridiculous terms and they will claim to be a hard money lender. And it's clearly a scam. So how do you talk to hard money lenders or vet them? I know you gave some good advice, but anything else to make sure you're not going to get scammed?
I mean, I think you got to ask them what their underwriting criteria actually is, right? I also think if you're a newbie or a brand new investor and you're getting crazy, amazing rates, and that's a little suspicious, right? If it's your first flip and you're getting below 9% interest with no points, like that doesn't make any fiscal sense, right? To understand that, you have to understand how hard money lenders actually raise capital and debt themselves, right? They typically have people that lend them money or creditors to them, and maybe they pay them anywhere between 4 to 7% interest. And those creditors are also going to be asking that hard money lender, what's your underwriting criteria, right? How do you manage your risk, right? So that hard money lender is being told or instructed essentially by their creditors, hey, if you have risky borrowers, like you need to increase your interest rates, right? So the biggest telltale sign to me in a scam is you're a brand new person, you don't know what you're doing, and you're getting rates that don't make any sense, right? It's impossible for them to give you 7%. If you see it, run. That's the number one sign.
Gotcha. And then you talk some about the terms like interest rates in points, but what about down payment, right? Like if I see a house that I think is worth $200K and I can get it for $140,000 purchase price, like how much money do I need to be prepared to bring to closing?
For experienced investors, you're going to need, for the total project cost, I'm assuming there's a flip, a rehab cost, and the purchase price. You might be able to get 90% of the entire project cost funded by a hard money lender. I think if you're a newbie, plan on bringing 20% of the money or having to raise the other 20%, maybe privately, right? Maybe you combine private money and hard money. Let's say it's a $100,000 project. Maybe the hard money lender says, hey, you're a newbie, I'm going to give you 80. And then you go to your brother, uncle, sister, your mom, and you say, give me the other 20, right? And that's how you fund the project. You just have to tell the person that's giving you the money privately in that equation, hey, if this project fails and I don't pay anybody, that lender's getting paid first, right? So the hard money lender is always going to be the first person owed, and you pay everyone else after that. They're in second lien position. That's what it's called.
Gotcha. And do we have any hard money lenders that we want to recommend at this time?
Yeah, we have Trophy Point, Samir Patel. is awesome. We've been using them for the majority of our cash purchases for the last 4 to 5 months, and their transaction fees, their processing speed, the customer service is like top notch, excellent, the best I've encountered, and that's really what's keeping us coming back. I also think their rates are super fair. They're not going to get you the rates like Lending Home provides at like 8%, but then you're getting the good experience, right? And I really enjoy it.
Excellent. So let's say I don't want to use hard money and I want to go the private money route. It could be scary, right? Like to ask people for money, might make me feel weird, right? Or feel embarrassed, right? How do you get over that fear, and what are some of those first steps to raising private money?
Yeah, it's the number one blocker, I think, in terms of raising money is imposter syndrome. People think they're undeserving of borrowing people's money because they haven't done enough deals, or they're not smart enough, or maybe they're scared the project could fail, right? And here's the thing, right? If you're going into these transactions with good intentions and good deals, you're probably going to make money, one, right? Like if you're getting good deals consistently, you are running a real business, and people should be lending to you. That's a good return. If you're offering 8 to 12% interest to a lender, that's better than letting it lie around, for sure, especially with inflation creeping up. The second thing is, if you're going in with good intentions, and let's say you lose $5,000 in the deal, you're going to pay them back, right? Like you losing $5,000 is irrelevant to the lender who's been making 9% on the transaction, right? They're still happy. So go into it thinking like, if I'm going in with good intentions, I have some reserves to pay people back, and I'm getting good deals, the risk to this person is extremely low, and it's backed by an asset. It's actually an incredible deal, right? Like your deal is better than any asset-backed security you can find through Google, right? Asset-backed securities are paying like way under 5% interest on the institutional side. So you're like the best show in town. So take that imposter syndrome and just put it to the side, because I think it's really crap, right? It's a good product is what we're offering.
I love it. We look in the mirror, we beat our chest, and we say, okay, I'm confident I can do this. Then what?
It's like any sales funnel, right? At the top, you got to dump eyeballs into the top of your sales funnel. How many people am I reaching, right? If you reach 1,000 people, eventually a couple of them are going to want to deploy their capital with you if you're raising money privately. So a couple of things we did. I talked about the social media persistence before. Go on IG, go on Facebook, tell people what you're doing, right? Eventually someone is going to go into your DMs and be like, I'm interested, right? Tell people you're passionate about real estate. That's one. It's easy and it's free. The other thing we did, and if this is applicable, especially if you're a wholesaler, you probably have a mailing list or people customers you're contacting on a recurring basis. We threw out in a quarterly newsletter that we used to write, or we still write, and we were like, hey, we're going to buy more houses this quarter. We're looking for capital partners, people to deploy capital with us. If you're interested, reply to this email. And we got like 10 people off of a list of, I don't know, we had 2,000 buyers at that point, maybe on our list, and like 10 people responded. And I think one of those converted into a lender privately. So that's another thing right there. If you're involved in real estate, another way, agents, right? If you're doing deals, I'm sure you've talked to a dozen or so agents, or maybe more, and they probably know someone who's involved in private lending, because they're probably networked with other flippers, and maybe they understand how they do their operations. So that's definitely another way to do the hustle, or to get eyeballs in your funnel. And then this is another one someone taught me recently, I'll share. So we had someone in our mastermind, Paul, that said he actually went into PropStream, which is a tool we use to pull lists, right? List of distressed properties. But he actually flipped it on its head. He said, I want the names and phone numbers of people who own houses worth over $1 million in the city I'm buying the house. And he sent them a postcard. And it was like, hey, I'm an investor in your area. I offer an awesome rate of return. I'm buying houses near you, and I'm fixing it up. I'm making the area better. Would love to have a conversation with you. Here's my email and phone number. And actually I think Larry Dixon, our CPA, did that and also had some bites, right? So they used wholesaling and like direct marketing to essentially raise capital, which I'd never heard before, but I now know 2 people that have done it. So I think the lesson there is like, whatever marketing works in other businesses, like also works for you personally, so that's the lesson to take away.
I love that. That's a really good tip. Like that's super good. So let's say our uncle's got a bunch of money and he says, "Hey Frank, yeah, sure, I'll do it. I want to get on one of these deals. What kind of terms are you going to give me?" Where do you start that conversation with terms?
I think you ask what terms work for you, especially if you're new. I think there's a really common mistake, especially for type A personalities. They're trying to win everything, and you come in and you're like, "Well, I'm paying you 7%, right?" But then that person's going to Google what is the normal interest rate in a private transaction, and it's going to be higher than that, right? And they're going to be like, "Well, this guy's coming in here trying to bully me, right? I'm no longer interested." Ask them what they want, right? You don't know what they're going to say. I've had people say anywhere from 7.5 to 10 or 11, right? You don't know what they're going to say because you don't know what they're making on other investments, right? So just ask them the question first. I think that's the most important thing. The other reason I like doing it that way is then they're happy, right? And a happy private lender will give you money again. And like I said before, interest rate is really not that important if you're only holding homes for 3 months, right? Like, what are you going to save on a $200,000 house? Like a couple $100? Like by arguing over interest rate, it's irrelevant, man. Like I said, availability is the number one thing. If you have people that can give you money quickly, you should value their money. So,
gotcha. And then what about size, right? What if I send that out and my uncle goes, "Yeah, I definitely want to invest with you. I've got $1,200. Like, can you put my $1,200 to work?" Like, what kind of size or scale is appropriate?
I advise people. I don't like having more than one private lender in a deal if I can avoid it, right? I think the only thing that would be acceptable at this point is maybe if I'm trying to make some decisions on the rehab and that number is a little unclear, maybe I have someone do the purchase price and I come in with another private person to do the rehab. But anything more than that is, like, to me, overly chaotic. And I think if you do your marketing and salesmanship correctly, it's not needed, right? So if it's a $12,000 person, or less or something like that, I would just say don't do it, right? I think if you're actively marketing and presenting yourself in a good way and you're getting good deals, you can get people to give $100,000, $200,000. And honestly, if you're struggling with that, just go back to the hard money lender. Like, having more than 2 private lenders in a deal on a single family house, to me, is kind of odd and unnecessarily cumbersome, for my vocabulary word of the day.
Gotcha. And then, so let's say you do your first deal, you raise money for it, you get it closed. You raise money maybe for a second deal and get it closed. How do you sustain? Do you have a funding funnel that you're constantly working? Do you just pick your favorites? Are you always looking for options? How do you think through that?
Yeah, so I think it's a challenge, right? There's definitely a challenge here. I think at the beginning, you have to have a sales funnel. We have a pipeline in our CRM, and it's just dedicated to lending. And I think when I was really, really hustling it, there was like 40 to 50 people in there. And I would keep track of it, like how much money they had, what interest rate they want, right? Are they willing to lend on creative deals, or do they just want to do standard flips? Like, I had all the stuff you would keep in a CRM. We kept track of that for our potential lenders. So yes, manage your pipeline, right? But the challenge is you do 1 loan, then you do 2 loans. Then one of the lenders is happy and they want to do another one, right? You can't just continuously hustle and have 50 lenders unless you're doing a ton of deals, right? Eventually, you want to reward that lender by doing another deal with them, especially if they want to come back and be a repeat customer. So I think it's natural and logical. Assuming your volume of deals stays flat, the hustle will decrease over time, and you will likely start using a repeat lender. And you can continue to strengthen and nurture that relationship over time. Maybe the terms also move in your favor a little bit because they're happy and they trust you, right? The less risk they take on, the lower rates they probably end up charging you in the long run. So eventually, I think the hustle decreases unless your acquisition is so strong that you need a ton of money. And then eventually, I think you'll turn into like a private equity fund or get a massive line of credit. So the funding, it just changes, right? Eventually, there's a point where you can't raise money asset to asset anymore. And I don't know what that number is because we're about to cross that threshold. So I'm trying to figure out what that is, but it's somewhere out there.
Yeah, can you talk through just our real estate company, Greyline Investments? Can you talk through our evolution over the last year of kind of where we've started and where we are today and where we think we're going?
Yeah, I mean, like I said before, we raised the money privately in July. Then we've started having a really good relationship with our current hard money lender, Trophy Point, somewhere around November. They've been funding a lot of our deals. But now we're getting to the point where we bought, we have a couple purchases, a couple homes we're buying. This week we bought 5 houses the week before. And I talked to you recently. I was like, hey, like, eventually we're going to get to the point where I can't go to Trophy Point, 5 times a week and raise money that way and also pay the transaction costs and the origination, the fees. It won't make sense, right? There's a certain point where it doesn't make sense to do that anymore. So right now we're really focused on proving out our business concept, right? We have acquisitions generating a lot of deals off of hustle. It's almost all outbound marketing, right? The next step there is, can we do inbound, right? To increase our deal flow. And then now we're training our sales team on the wholesaling side to also flip houses and to also manage assets, which I've been holding on to for a while, right? So what we're kind of doing is we're scaling the business, proving out the concept that we can buy a house anywhere. And then we're going to go to potential investors and say, hey, look at this awesome machine we built, right? Now let's get the line of credit going, right? Or eventually maybe that turns into some type of like they're lending to us and it turns into equity at some point, and then you're becoming like a fund. So I think for us, it's like we're raising money asset to asset. We're getting good terms on hard money and private money right now. But once we prove out our concept, like we're going to look like a real company. I think your funding model changes. So,
gotcha. And then whether it's us or someone listening trying to raise money, are hard money lenders and private money lenders lending on the deal or lending on the person, right? Like loaded question, but how do you think most of them look at that? Is it the person? Is there a personal guarantee, or is it just strictly the deal? Is a credit score involved? What do you think?
Well, I think it's primarily the person actually, and secondarily the deal. It's always both though, right? That's the two securities a lender has. It's the person they're giving the money to, or the organization, and the deal itself, right? Typically, from what I've seen, lenders in an average market don't want to be lending more than like 75% of the overall value of the home, right? They just don't want to, because that's when their risk starts to creep in. So the deal is important. But you're the most important, right? If you're speaking to them and they're asking you about what are you going to do to the house, how are you going to manage the project, and you look like a moron, right? Like they're going to get scared away and they're probably going to back out or charge you interest rates that are so onerous that you're not going to want to do business with them anyway. So they'll just price you out of the deal. So I think it's primarily the person. And there's a lot that goes into that. I think your credit score, your history, right? How many deals have you done? Maybe you were referred to that lender. That always helps too, because then, there's a relationship there. But sounding the part is a big deal, right? Like going on the phone and being able to speak real estate matters a lot to that lender in most cases.
Gotcha. So as you mentioned, we bought 5 houses last week. We're buying more houses this week. We're buying houses all the time. And if we're getting hard money, potentially high interest rates on these houses, how do we as a company cover our downside and make sure we have a margin of safety in case the market starts going down? How do we think about that?
It's the biggest way to hedge risk in flipping houses is paying low prices. It's the hedge that I feel like actually right now, a lot of people are not abiding by that. A lot of people are overpaying for flips because the market's so hot. The market's kind of saving everybody on the back end. Like homes are appreciating to the point where they're appreciating more than your hard money loan payments probably are, right? Like that 1% of the purchase price a month you're paying is less than the appreciation in some markets. That's how crazy this is, right? So the market's saving people, but it's definitely about getting the best price. So that means to me, having a system where you can go direct to seller and acquire houses is the number one way to hedge risk to me in flipping. You don't pay the wholesaler, you do all the work yourself, you're cutting that middleman fee out of the equation, right? The other way I think you can hedge risk is by the type of house you acquire, right? In our case, almost every house we flip, we could turn it into a rental, right? So the option to maybe deed it over or figure out a way to do a refinance on the back end is there, right? We could refinance it, delay the eventual sale, and probably cash flow on that house and still get our lender the money back. So we're just acquiring a rental at a cheap price. We could do that in almost any of our houses. Thankfully for us, we haven't needed to do that because like I said before, the market's been so crazy that we've profited on every flip we've done in the last year. We haven't lost money yet, knock on wood. So yeah, we haven't had to, but our style houses, you could do that. So it's a nice option to have.
Gotcha. And if someone really enjoyed this conversation, but they want to know more about funding, any good resources you recommend?
Oh man. This is a YouTube thing, right? I think, you could read a book on like raising private money or hard money, but there's so much good content on YouTube University that I would just go there, right? Or if you want to get all the information consolidated in one place, like you could go to our channel because we're about to drop an entire course on funding deals. And I probably spent, 10 to 20 hours building that thing with all the decks and the videos. And I think I'm covering it in pretty good detail. So you could just come to us and we'll get you the information.
Excellent. I want to hear your favorite real estate story of, private funding. Okay. But first I'm going to do our commercial and then you can take it away. Okay. So here is my ad hoc commercial that I've done multiple weeks in a row right now. The real estate market in April 2021 is crazy. Some would say it's on fire. We are buying properties all over the country. We prefer Texas and the Southeast United States. But if you've got a deal, our company will buy said deal. So if you have a deal, email it to us at deals@greylineinvestments.com, GRAY, greylineinvestments.com, deals@greylineinvestments.com. Our acquisitions manager, Adam Parsons, will check out that deal and give you some feedback. And if we like it, we'll buy it from you. We will partner with you to make sure you get paid. We will flip it. We will buy it. We want to be your cash buyer. So Frank, back to you. Give me an awesome story with private funding.
I have a story, but before I say it, are you thinking of a particular story?
No, I know I just threw this on you, and I've got one from before we started doing deals together I can share as well, but I don't necessarily have a specific one.
Okay.
I know together we've got 4 or 5, but whichever one you come up with, I'm sure will be good.
I'll do a recent one where I actually lent the money. So I recently just moved my 401k into an SDIRA, which basically is a retirement account that I can direct, self-directed. I can direct where the money goes. You can invest in real estate or lend out of an SDIRA. And I just moved it over like the day before this happened. And we sold a deal, and it was our contractor in Fayetteville bought the deal. They went to the walkthrough on our behalf to just estimate the rehab, and they were like, yo, we'll just buy it. I was like, all right, cool. Like, we'll just take the profit, And then the next day, one of the guys in the company called me and was like, yo, do you know any good lenders? I was like, oh, I didn't realize you guys, were on the market for a lender. And my retirement account was actually like just about enough to cover the entire, the entire project cost. And so I was able to make, a little bit of profit on the deal. And then I was able to lend the money out. And I was like, man, I got lucky. That's pretty awesome. So that's a pretty cool story, I think, to lend out personally on one of the deals you found. That's pretty awesome.
That's cool from front to back. My story is a fourplex in Oklahoma that I looked on the county website. You've heard this story before, Frank, but I looked on the county website, figured out the owners of all these fourplexes, then sent them all postcards or letters and was like, hey, are you interested in selling? Got some calls back. Got it was probably $225, $245 after repair value. Got under contract for $180,000 with this lady, and then used a family friend to bring that $180,000 cash to closing. They brought all the money. We paid them 8%, right? But we closed on the house or the fourplex. No payments for 12 months. So we got all the rent coming in for those 12 months. Then we refinanced with a loan, paid back the $180,000 with interest at that point. And we still own that fourplex right now. And we got it with no money out of our own pocket. So that's a pretty solid story.
That's a lot of hustle, right? I think you pretty much put every strategy we talked about together in one deal. But you also touched on something we didn't really discuss. You kind of asked before, how much leverage should you have, right? You kind of implied that. I didn't answer. And my answer is like, if your deals are good, to the moon, like if your deals are really good, I mean, hey man, lever up as much as you can, because that's how you can do 100 of them, right? If you're consistently finding quality deals, keep your money out of it, right? If you're not finding quality deals or you're insecure about them, maybe put some money in once in a while, get your feet wet. But once you have confidence, like use as much as you can.
Yeah, I agree. There's a risk and reward balance, right? But what's the difference between buying a property for 100% of value and putting down a 20% down payment, or just buying a property at 80% of value and not putting any down payment, right? Theoretically, the risk is the exact same. But awesome. I really appreciate it, Frank. I think that was a huge value add. You got any final words for us?
No, just don't be scared. It's about sales. It's about hustle. Raising money is another sales funnel. It's another pipeline to manage. And especially if you're starting, I'd get ahead of it, right? Because you don't know when that deal's coming. So you should be ready.
Excellent. Thanks everyone for listening. Every week our listeners are going up and up. So we just want to say we really, really appreciate it. We're looking to bring in some awesome guests and to continue, instead of doing the paid course, we're going to put a lot of that information out on YouTube and through this podcast. So thank you so much for listening, and